Not yet,
No.
yeah? Hold on. What was I sharing just now? Stop sharing. Shared the wrong screen. Wow. Now it's hang. Stop presenting. It's not working. It's not working. It's not even recording yet. Dah.
Nanti dia cakap lagi record.
Okay, Assalamualaikum warahmatullahi wabarakatuh again. Alright, so today we are going to look into your tutorial question. Right, so I give you two sets of tutorial questions. So we'll go for the first, this is the S company, right? I'm not sure it's state receivable 2. Have you done this? All right. Can you hear me clearly first?
Yes.
Okay, yeah. All right.
Yes,
So
madam.
we are going to do this tutorial trade receivable 2. I'm not sure why I want to do this, but because when I open it, it's that question. So I hope that if you have done the question, it's good. So you can check your workings. If you have not done that, it's still okay. All right. We'll go through it together. I hope that you'll be able to understand what we have covered in the last class. It's all theoretical, but we're going to put that into practice. Okay. All right. Before we do that, all right, let me just review a bit, all right, on the accounts receivable. I have made this summary, right? And later maybe I can share it with you so that you can refer to this. All right, so we are talking about accounts receivable, right? So receivable, is it like that? Receivable. Okay, hopefully, yeah. All right, remember. So when you have account receivable, it means that you are actually making sales to your customer on credit or on account. What it means is that when you make sales or when you perform your services, you do not get cash immediately. All right, your customer will pay you in the future. So accounts receivable is an asset. Yeah, so it's a it's an asset. All right, whether it's current or not, depending on how long is the credit period. All right. So for the journal entries, right? So we know that when you have a sales, I will do it like this, so that just to give you a summary of what is all about, right? When you have a credit sales, your journal entry would be debit your accounts receivable, right? Receivable. All right, you debit your accounts receivable and credit your sales account. Yeah, it could be sales revenue or sales only. It's okay. Yeah, you credit your sales revenue account, and so this is what happened when you make a credit sales. I remember that a company can have a credit sales or they can have a cash sales. So what we are looking at now, account receivable, so we are only referring to credit sales, right? And then, right, what happened is that after some time, all right, depending on the credit period given to the accounts receivable, all right, so there would be a kind of settlement, right? Payment from customer on your, let's see, I copy this. See, payment from your customer. So rather than this one, we put it as a payment from customers. Yeah. So when you receive your payment from your customer, you're going to get your cash. You're going to pay your accounts receivable. Yeah.
Madam,
Yes.
screen
Yes.
tak jelas sangat.
Sorry?
Screen tak nampak. Tak jelas.
No. What do you
Dia
see
blur.
then?
Blur.
Blur.
Ha.
It's a bit blurry.
Macam mana tu nak buat tu?
Maybe
What to do,
because of the internet.
Internet, my internet?
Yes.
Don't know how. What can I do about this? Is everyone seeing it as a blur screen?
Yes.
Yes.
Yeah.
Yes.
So what to do?
I think you can try to switch off your camera first.
Switch off mine?
Madam, maybe is there a way to refresh your the screen present? Maybe turn off and turn it on again.
Okay, I stop presenting. And then I will present again. Okay, can you see this? What is this? Right, can you see that clearly?
Yeah.
Not yet. No good.
Yeah, still not.
It's the
It's coming?
same. But it's
Can I see?
better.
Hello, hi. How?
Better, madam.
Okay, I try, okay? Okay, so coming back. So number one is that when you have a credit sales, you're going to debit your accounts receivable and credit your sales account. Yeah. And then, all right, when your customer make payment later, right? So when you receive payment from your customer, you're going to debit your cash, credit your accounts receivable. The problem is that when you have uncollectible debts, so it means that your customer purchase on credit and they're supposed to pay you, but later after so many reminders, all right, they're not able to pay you. So when there's an uncollectible debt from your customer, and this is what we say that it's already confirmed that the debts are uncollectible. Yeah. So we are coming out with one account, what we call ADD, or allowance for doubtful debts. Right? So when you have uncollectible debts, so normally it will mention to you how much is the value of the uncollectible debts, right? And then if it's clearly is uncollectible, right? It's not estimate, yeah. It's a clear saying that it's uncollectible. Then you're going to debit your ADD accounts, your allowance for doubtful debts account, and credit your accounts receivable. Right. I think that maybe I have to show you like this rather than insert like that. All right. Uncollectible debts. Right. Okay. Maybe this will make more sense. Why? Because normally in accounting, before it actually happened, we actually have estimate. All right. We provide how much is the bad debts of the, not bad debt, estimate how much from the accounts receivable that will become bad. All right. So this one has not happened. So that's why it's called estimate of debts. So when you estimate of your bad debts, all right, the method that you're applying is that the allowance method. The entries for you to estimate how much your bad debts normally is given in the form of, they give you percentage, all right, of the uncollectible, and that amount is determined by computing, all right, the balance of account receivable times the percentage given. All right, so for example, you say that out of all your balance of your accounts receivable, all right, 2% is estimated to be uncollectible. Can you see that? So it's just an estimate. You only provide a provision, right? So when you have that, then you have to compute what is the estimate of your bad debts. So we compute the amount by looking at the percentage given times by the balance of the accounts receivable. So this is what we call the estimate to be for the year, right? So what you do is that you debit your bad debt expense and credit your ADD. What is ADD? What is ADD?
Allowance for doubtful debts.
Allowance for doubtful debts, right? So when you have these, all right, remember that when you have this estimate, you do not actually cancel out in the accounts receivable immediately, all right? So it does not involve your account receivable yet because it's just an estimate. But if it becomes a clearly an uncollectible debt, all right? So or what we call, sometimes we call it as a, it becomes a bad debt, right? So when you have debts, then whatever you have provision here, all right, you're going to debit that amount.
Madam, are you there? Because we cannot hear you.
Welcome back. It's still a recording. I'm not sure what is recorded, but later when you watch the recorded video, right, so you can skip wherever it should be. Can you hear me clearly?
Yes.
Yes, madam.
All right. Okay, let's see if we are still there. Okay, can you see my worksheet now?
Yes, it's
Yes,
okay.
madam.
Is it clear?
Yes.
Yes.
All right. Good. Okay, now coming back, all right, we have number one is that when we have a credit sales, number two, when we have a payment from your customers. Yeah, so when first we debit your account receivable, credit your sales, and then when you receive payment from your customer, you debit your cash, credit your accounts receivable, because now your amount due from your accounts receivable is reduced. Okay, I think that the answer they use, rather than they use account receivable, they use a trade receivable. Yeah, because if you're talking about trade, it means that trade receivable refers to your sales, all right, the normal customer that you have, so they put as a trade receivable. If you put accounts receivable, it's also acceptable because I normally use account receivable. Yeah. Okay, and then what else? Estimate of bad debts. All right, remember that is the percentage of your balance of your account receivable. So later we'll see what do I mean by the balance of account receivable. All right, so this one the estimate for the whole year. And uncollectible bad debt, when it becomes bad debt, you again debit your ADD, credit your accounts receivable, right? And then we also have this what we call bad debts recovered. So remember that previously, when you have a bad debt, all right, you have actually credited your accounts receivable. And then suddenly after some time, all right, your accounts receivable comes back to you and say that, hey, I want to pay whatever I owed you last time. Right? So you have actually credited the accounts. So when the customer come back to you and want to make payment, all right, you cannot simply just accept the cash. You have to open up again the accounts receivable. So that's why when I said the bad debts recovered, you have to first open that accounts receivable, all right, with the amount that they come back to pay you. All right, so you have to open up a debit account receivable and you credit your ADD, all right, whatever amount that the account receivable wants to pay you. So, and then the other transaction is that you have to record debit your cash. Now only you credit your accounts receivable. So if you look at here, you debit your account receivable in order to create the account, all right, and then you debit your cash and then credit your account receivable again, all right, in order to set off the account that you have opened just now. All right, so for example, if they want to come back and pay you 3,000, so you open account receivable 3,000, all right, and then credit your ADD, and then the second transaction you have to record is you're going to have to debit your cash. All right, so when you debit your cash, only you credit again your account receivable. So if you have debit 3,000 here and then you credit another 3,000 here, then your account receivable now is zero rise. Right? Why? Because first you have to create the account, then only you have to cancel out the account. Kau tidur sana. Kau nak. Okay. 50 ni. Jangan dah, bebas. Baik. Kau hantar abang nanti tak?
Okay. Tidak cakap uncle ada kat rumah kita.
Okay. Baik. Cakap dia kursi yang lain kan kita hantar next week. Kalau kursi
Semua dalam tu kasi tidak iya.
Itu semua tidak iya. Okay. Alright, that is called domestic issues. Okay. And then, alright, we have bad debts recovered. So remember that when you have bad debt recovered, there are 2 journal entries. And then we also have a situation whereby initially you open up an account receivable and then your debtor say that, oh, I cannot pay you within the period that I promised. So now I want to open up a note receivable, right? So you issue note receivable means that in the note, what's the difference between account receivable and note receivable? Note receivable is a kind of contract that says that, okay, this is the amount that you owe me, how much you have to pay, plus the interest and the period they have to pay me later. All right. So when in that case, you have to create notes receivable. So you debit your notes receivable, and then, but you are going to cancel the account receivable because now the account receivable becomes a notes receivable. So that's why you credit your accounts receivable. Yeah. And after some time, when you make payment on the notes receivable, all right, you receive payment from your customer on the notes receivable, you debit your debit cash and credit your accounts receivable, or in this case, notes receivable lah. Yeah. And remember that there's always a portion of interest income, right? And throughout the year, for example, if the notes payable that have a period of, for example, 6 months, but that 6 months period covers 2 accounting years, right? So you have to recognize the interest income, which is accrued, right? Accrued during the year. So what you have to do is you're going to debit your interest receivable, right? Because you're going to receive that later, yeah, not now, but you're going to credit your interest income. Why credit? Because interest income is a revenue, so that's why you credit. But once you make payment, all right, so you remember that you also have to credit here, credit interest receivable. Okay, what happened is that, okay, let's do this again. Rather than having it here for my ad, let's have it here. Right, so you accrue. So the transaction normally is that you have to accrue interest first, right? So during the year, you're going to accrue your interest. So that's why you debit your interest receivable, right? And then you credit your interest income. And remember that this one is whatever your principal times by percentage of your income or of your interest times by N. All right, and remember that N could be on a monthly basis, it could be on a yearly basis, or monthly means that it could be 6/12, yeah, or it could be on a daily basis, yeah. So it depends on the information provided to you. So during the year, you're going to accrue the income, yeah. So you debit your interest receivable, credit your interest income. But then when you actually receive payment from customer with interest, then you debit your cash, and then you credit your notes receivable, your interest income, as well as your interest receivable. Yeah. So the interest receivable that you're going here is actually the one that you have it here, right? So because you are setting off the interest receivable for the period that you have accrued just now, right? Is that clear? All right. So later, okay. Question before we go into your tutorial question. Question before we go into tutorial question. All right.
Madam,
Yes.
why we do not write the allowance for doubtful debt, the estimation in the account receivable?
Okay, again. All right, because when you have this is just an estimate. This one, is it?
The estimation.
Estimate, this one.
Yes.
Because this one is just an estimate. So you cannot cancel out your account receivable yet, because of course, if you when you estimate and suddenly you reduce the account receivable, of course account receivable will be very happy, right? It's not actually become bad. So that's why you cannot credit your account receivable.
Oh, okay. Thank you, madam.
Right? Because it is estimate here is just from your company provision. Right? You just remember accounting, we have the prudence. We have always estimate something that will back happen, then we prepare for it. All right, we prepare for things. All right, we have the insurance, all that. Yeah. So this one is the same estimate. It's just that based on the amount, okay, we estimate how much is going to be bad, but estimate only, but it's not yet become bad. But number 4 here is the one that you clearly know that, okay, this one become bad already. So once you clearly know it become bad, then only you credit your account receivable. Is that clear?
Yes.
All right. So let's look into your question. Mana I punya hilang ke apa? Oh, I belum buka balik. Mana I punya yang buka tadi?
Excuse me, madam.
Sorry?
Can I ask about the earlier in the Excel?
Which one? Apa hilang sikit sekejap ya? Okay. Your question?
The the last number 7 and number 8.
Okay. I can
The
hear
why-
you clearly.
Why the number 7 we credit interest income and the number 8 we credit it also?
Okay, you have to repeat that. Number
Yeah.
7 or number 8?
Both, madam.
Okay, so this interest income is during the year. Okay, remember in the last class when we have that you issue a notes payable assuming that it's a 10% per annum. But the notes is only for 6 months period starting from 1st of October. All right, so you're going to, so means that if your year end is 31st of December, right? So I put it here. Your notes start on 1st of October. So year end is 31st of December. Okay, but your maturity of the notes is, let's say 6 months, October, November, December, January, February. So it's going to be on the 28th of February. Is that clear? Does that make sense? So this one is let's say 2021, 2021, and here is 2022. So what happened is that during this year end period, 31st of December, you have to put and you have to recognize your interest income. All right, because remember interest means that at 31st of December, you already have accrued income for the period from October, November, December. Right, October, November, December. So kalau October makna sini October, November, December. So sini should be 31st March lah. Isn't it? 31st March pula. Is it? 6 months. Right? Let's say it's a 6 months notes. Notes receivable. Yeah? So what you happen is that assuming that the percentage is, the rate is 10%, right? 10%, and the principal is, what is it? Principal, let's say, is a 1,000, right? So for 31st December, you are going to recognize interest of 0.1 times by 1,000 times by how many months? October, November, December, 3 months, but the period of maturity is 6 months only. So you're going to recognize interest here is your interest receivable. Why is it interest receivable? Because you have not received the interest. You're going to receive the interest on 31st of March. All right, but you are going to receive, that's why it's an income to you, right? It's an asset to you, not income, yeah? But your income is what you have to recognize is your interest income of 50. Yeah, but when it comes to the payment, the maturity, not 31st March, 31st of December. But when it comes to 31st of March, then you're going to receive how much? You're going to receive cash of 1,000 plus, what is the, plus what? Interest, how much is your interest? Macam mana kira? What I do is that I would put plus 1,000 times by 0.1, which is the tax rate, the interest rate, times by the period is 9/12. Why 6 of 9? I sebut 26. 6 months period, right? Why you have to times by 6/12? Because the 10% is per annum. Kenapa sama dengan ni? 6/12. So this one, I buat apa ni? 3/6.
3/12.
3/12. You see? Betul lah. Sorry, thank you dear. Right, so because the interest is per annum, it's always, even though it's not mentioned, it's always the interest mentioned is a per annum. So E per annum means that if it's for 3 months, or 3/12, but the period that you're given is 6 months, so 6/12. Yeah, so you're going to receive what is this? 0.1, I would say macam mana nak buat? I will put it like that. This is the interest portion, right? But you also receive the principal amount of 1,000. That's how you got 1,050, right? If you want it to be easier, you times by 1.1, right? So 1.1 means that the principal plus the interest of 10%, right? 1.1 means that interest is 100%. The principal is 100%, the interest is 10%. So when you receive cash means that you're going to credit your accounts, notes payable, right? So that's why you do this. Notes payable lah. Notes receivable. Kenapa ada banyak salah hari ni? Right? And then interest income, command C, command V. Right? So notes receivable, how much you're going to credit? You're going to credit 1,000 because that is the principal portion. But the interest income that you're going to recognize here is only the balance, 25. Why? Because you have recognized income here, 25 here. Right? So you have 25 here and 25 here. So you already have recognized that when you okay? So you only recognize interest income for the period from January, February, and March. The interest receivable that you credit is the one that you have debited in December, which is 25. So from here you get 1,050. Okay? All right. So let's go. Never mind. Who asking me just now?
Me, madam.
Right? It's okay. Let's look into the question on your tutorial question. Mana banyak punya soalan tutorial question ni? File, open recent file, midterm. I don't have it there. Mana I punya Finder pun dah hilang. Finder. Okay, hold on. Give me a few minutes. Share drive. We have FAR1. Tutorial on receivable. So receivable 2, isn't it? What is that? Okay, let's look at the first question. Can you see the question now clearly?
Yes, madam.
All right. Okay. December 31st. All right. Whenever you do this, all right, take note of the period given to you. Right? You have 31st December 2016, report total sales. So this one is total sales of 4.5 million, of which 500 is cash sales and the balance are credit sales. So you have to decide what from 4.5 means that 500 is cash sales, then the balance is credit sales. So how much is the credit sales? Hello?
4 million.
4 million, all right? So because from the total sales, you have 4.5 total sales, 500 is cash sales means that the balance is a credit sales, so 4 million. And then you are given the balance. So these are the balances that you have to take into account when you do your T accounts, yeah? Amount owed by debtor Milky Company amounted to 3 million would most probably, so you say would most probably be uncollectible. All right, and but the company, it also said that the company decided to write off. So when the company decided to write off, is it an estimate or is it a bad debt already?
Bad debt already.
Bad debt already, yeah. So because of that, you have to do one entry just to recognize for the bad debt 3,000. The second statement says that the bad debt expense is calculated at 0.2% of your credit sales. Right? And then you have another one, you have a payment of 2,000 received from a debtor whose account was written off. So what do you understand by this? What is this? The 2,000. What do you call this transaction?
Bad debt recovery.
Bad debt recovery. All right, means that your debtor Sunlight Company, you have written off the account, but now they come back and want to recover their debt. So you have to do the respective journal entries. All right, the requirement is that prepare journal entries to record adjusting entries for uncollectible accounts, yeah, on the basis of sales method, on the basis of percentage of sales method. Open the accounts for allowance for doubtful accounts. So sometimes I call it as allowance for doubtful debts, ADD. Another account called AFDD, allowance for doubtful debts. Yeah, so ADD, ADA, AFDD is the same account. Yeah, and post relevant transaction, and then you show your accounts receivable and your allowance appear in the financial statement of your financial position. So for your account receivable, these are the common requirements, right? Number one is prepare your journal entries and then open up your allowance accounts, and sometimes they also want you to show the accounts receivable, right? So let's do this. All right, so what are the transactions that we have? We have number one is that we're going to write off this 3,000. So how do you record your write-off? Whenever there's a write-off, bad debts, all right, you're going to debit your uncollected bad debts, all right? Debit your ADD, credit your accounts receivable. So let's look at the answer here. What they do is that the journal entries is that debit your ADD, 3,000, and credit your accounts receivable. Is that clear? So this is for number one, all right, when you have the bad debts write-off, yeah? Okay, number two is that you have to do the 2% here. So the 2%, careful, yeah, they say that the bad debt expense is calculated at 2% of your credit sales. So what is your credit sales? The credit sale is 4 million. So what is bad debt expense? Is 0.2% of your credit sales. So what you do is that you just time 0.2% times by the 4 million credit sales. Remember that 0.2% is 0.2 divided by 100. All right, so you don't time 0.2, right? It has to be 0.002. Careful with that, right? So what you have is that you have the 0.2% times by the 4 million, right? If you have your calculator, what you do is that you have 0.2% times by 4 million. What do you get? You should get 8,000, right? So when you have an estimate like that, right? So this one is what we call bad debt expense. So that's why the account is bad debt expense. You debit your 8,000 and credit your ADD 8,000. So this is similar to what we have here when you have the estimate of bad debt, debit your bad debt account, credit your ADD account. How you get the amount? Percentage times by the balance of your accounts receivable. So that's how you get the 8,000. Is that clear? Okay. And then you have a payment of 2,000 received from your debtor. So this is a recovery. So when you have a recovery, you have two journal entries. One is create account receivable first. So debit your account receivable, credit your ADD, 2,000. Then the second entry is your debit your cash 2,000 and credit your accounts receivable. So the answer here is that you have your debit your account receivable 2,000. Do first you create the account and credit your ADD, and then debit your cash and credit your ADD. So by having this double entry here, right, account receivable now is zero, right? So that will be your journal entries. And you are required to open up allowance for doubtful debts, right? So you're given that the balance of ADD is 6,005 on the credit side. So you have opening balance of 6,005 here, right? And then, right, you put in the transaction that you have for the earlier one, right? So when you look back here, right here you have ADD, right? And then you have ADD here. So put in all the transaction that you had into the respective T account. So here you debit your ADD 3,000, here is your 3,000. Right, and then here credit your 8,000 ADD, credit your 8,000 ADD. And then another one is that you credit your ADD 2,000. This is your credit ADD 2,000. So once you have these, all right, then you compute what would be your balance carried down figure. Your balance figure is actually looking, because remember this one is a credit balance, so you get the total on the credit side, right? So total on the credit side, and then these are the balancing figure, right? 16,500 minus 3,000, that's how you get 13,500, right? So in the accounts, all right, in the exam, normally you'll be tested if you have the journal entries and the accounts. We are going to look into your opening balance and your closing balance. Yeah, so you have to show the transaction in the journals as well, reflected in your ledger. So far, so good? Are you okay?
Yes, madam.
Right. And then the third requirement is that you have the T accounts for ADA and show your accounts receivable, right? So your accounts receivable, all right, it's not simply that you can have the balance. You have to show a bit of the account receivable here for the workings, right? In order for you to show your account receivable in your statement of financial position, you have to show your account receivable ledger, all right? So remember that you have a balance, opening balance of 4,800 here. So the 4,800 is your opening balance, all right? And then, all right, let's make it a different color. Make it blue lah. Right, 4,008 is the opening trade payable, and then look into your journal entries. The first one is you credit your accounts receivable here, right? So you credit your account receivable, right? And then you have this one, no account receivable, but here you debit your account receivable 2,000 first, debit first, and then you credit another round here, so credit 2,000 here. So that is the journal entries that you have. And then from there, remember that this one is a debit balance. So when you have a debit balance, then you just take whatever 482 minus by the 5,000. So that's how you get a closing figure of 477. So this closing figure will appear now. You show in your financial position, your trade receivable balance now is 477,000. And then you minus your allowance, ADD or ADA. How do you get that 13,500? So this is the balancing figure, right? The balance here is reflected in your financial position. So your net receivable value is 463.5. All right. So far, so good. So that answer all the question for the question number 1. Right, you are required to do the journal entries, open up allowance, doubtful debts, and then show account receivable. Even though it doesn't mention here to show your T account, but in order for you to come up with the balance of your account receivable, you have to come up with the ledger account. So far, so good? Yes.
Can you repeat for T account again?
For the T account.
Yes.
So, account receivable.
Yes.
Which account?
The yang bawah, madam.
Ni, ADA.
Yes.
All right. So your ADA, all right, you have to open up your ADA account, right? So you are given in the question, ADA has a 6,000 credit balance, 6,500. So you start your account with the balance of 6,500. See that? On the credit side. Why ADA have a credit side?
Because in the question said for credit, right?
It is a credit, but for your understanding, all right, ADA is a contra account, right? What is a contra account? It's a contra account to a trade receivable. So trade have a debit balance, so that's why allowance has a credit balance, right? Remember that. All right, so you have a credit balance of 6,500, and then you plug in your journal entries related to ADA. So we have one, which is a 3,000 debited. So you debited here, 3,000, all right? And then another one, you have credit of 8,000. So you have credit of 8,000. So the description is that if you have accounts here is ADD, it means that you are going to debit your bad debt expense. So that's why the name is bad debt. So debit bad debt expense here, credit your ADA. So you have the 8,000. And the third transaction you have ADA is the 2,000 here. So you credit 2,000 in your ledger. So once you have all the transaction in the journal entries posted into your ledger account, then you total up on the credit side. Why? Because ADA is a credit account. So what you get the total credit, and then whatever is the balancing figure here is the balance for the period. So the balance for the period will appear in your financial position. Is that clear? For your accounts receivable, all right, remember that the question said that, okay, account receivable balance is 480 on the debit side. So you have a balance 480 on the debit side, and go back to all your journal entries related to accounts receivable. You have to credit account receivable 3,000 here, and then you debit 2,000 here, and then you credit again 2,000 here. So you have 3 transactions there, which involve accounts receivable. So you have the 3,000 credit, 2,000 debit, another 2,000 debit. All right. A trade receivable is a debit balance, so you get the total debit side, and then get the balancing figure, which is the 477,000. Is that clear?
Yes, clear, madam. Thank you.
477 will appear in your financial position. 477 minus by your ADA, 13,500. Okay. Bad debts here, all right, bad debts is an expense. It will appear in your financial position. Oh no, in your statement of profit and loss. Yeah. So you debit your bad debt, and then it will appear in your financial profit and loss account. Okay. So that is the answer for question number 1. Let's go into question number 2. Question number 2, on September 30th, Emerson has a 5425 account receivable balance. So that's the balance for account receivable. Emerson uses the allowance method of accounting for bad debt and has an existing credit balance in the ADA account of 13,750. So you should have your idea is that now you have an ADA or ADD credit balance of 13,750. And then you have transaction A, B, C, and D. You are required to prepare the journal entries, all right, and then show the account receivable, all right. They want you to show account receivable and account doubtful debt as of in your financial position. So in order for you to show the financial position, all right, I suggest that you always prepare the ledger, right, so that you can see clearly what will be the transaction that the closing balance that to be shown in your financial position. All right. So let's go through first, prepare journal entries. So journal entries is always for the transaction here. All right. Number 1 is that you sold 3 to 5,000, all right, merchandise to your customer on credit. So what will be your entry here? What will be your journal entries?
Debit account receivable and credit sales revenue.
Very good. All right. Debit your accounts receivable and credit your sales revenue. Number 2, you receive 425.1 cash in payment of account receivable. All right. So this one is receive payment. What will be your entry?
Debit cash, credit account receivable.
Very good. Debit your cash, credit your accounts receivable. Number 4, you wrote off 16,700 of uncollectible accounts receivable. So you see the term is you write off. So what happened when you write off?
Debit ADT, credit account receivable.
Yeah. Let me check the answer first. Yeah. Emerson. Because I put confused. Where is the? Alright, debit, ADD, credit because you write off, right? Bila you write off, you debit. Okay, let's look at the summary, betul tak? Yeah, when you write off, debit was uncollectible, so sometimes we call it as a write off. Betul? Debit, ADD, credit your accounts receivable. So for Emerson, you are going to debit your ADD 16,700, credit your trade receivable 16,700. Why you credit account receivable? Because this one is already write off. Okay. Number D, this is more challenging. In adjusting the accounts on 31st December, the company estimated that 3% of account receivable will be uncollectible, right? This one is, comment that. What I say is an estimated. So when it's estimated, means that you are looking at the closing figure of your ADA, right? Closing figure, and that estimated is 3% of your accounts receivable. So you have to compute what would be your balance of your account receivable, and then you have to work out what would be the ADA, right? Okay, let's, we have, so what would be, so it's difficult for you to decide now, because for me, right, bad debt expense, how to get to this is not a straightforward, yeah? Let me show you how. Okay, so we have, okay, let's, okay, leave this first, yeah, because we are not able to decide on the amount yet, because we have to be based on your closing account receivable. So your account receivable, remember that just now we have a balance of 540250. So that's your balance, 540250. And then trade receivable, here you debit 325. What else? Debit 325 and then credit 425,100. Any more trade receivable? Credit 16,700. So you put in all these 1, 2, 3 transaction in your accounts receivable. One is 325 debit, and the credit side you have 2, 425 and 16,700. And for that you have a balancing figure of 423,450. So are you clear so far on your accounts receivable?
Yes, madam.
Okay, because you have to know what would be your closing figure in order for you to compute what would be your allowance for your doubtful debts. Okay, so based on 423,450, all right, the question says that you're going to estimate 3% of your accounts receivable will be uncollectible. Right, so you say that in adjusting the account, so you want to get the adjusted closing figure for account receivable, which is now is the 423,450. So if you say that 423,450 is your closing figure, then your 3% of that would be how much? 12703.5. You get that? So what is this 123703? Or let's make it 12704. So what is this? What you call this? This is what you call is your closing, right? You want your closing of your ADA to be 12704. Okay. So what it means here is that in adjusting the account, the company estimated that 3% of accounts will be uncollectible. It means that your closing ADA will be 3% of your accounts receivable. So how you get the 3% of your account receivable? You have to decide what will be the closing balance of your account receivable, compute by 3%. So this is your closing ADA account. Closing, yeah? So now you have a closing figure. So you have to start from your opening balance. What is your opening balance? Is 13,750. So you put in credit side 13,750. Right? And then what? Look at your journal entries. What are the transactions involved? ADA. ADA, where is ADA? So you have one ADA here. Right? 16,700 debit ADA. And then you have another one credit. Oh, okay. You only have one. Okay, let's see. So you only have one debit 16,700. Okay. Okay, remember that. I will put it here. No fee. Okay. Let's delete this. you have opening ADA of 13,750 and then you have a debit of 16,700 and you also have a closing figure of 12,704. So for that, all right, you must know that during the year you have bad debt expense of this amount. All right, again, in order to have a closing of 12,704, you will have a balancing figure here. How much is the balancing figure? Is the total on the allowance for doubtful debt is this, how do I say that? Macam nak cari balance dia? Alright, your total 29,404 minus your 13,700. So you should get 15,654 as your bad debts, right? So remember what will be the entries if you want to estimate? When you want to estimate the amount will be estimate debit your bad debt expense. So that's why you are going to debit and credit your ADD, right? So how much you're going to debit? You're going to debit your bad debt expense of 15,654. So that's how you get the 15,654 and credit your allowance of 15,654. So that will be the closing fee, the bad debt expense because you have a closing figure for your ADD. Right? I know that this is a bit confusing for those who had the first time, right? But as you go along doing a lot more question, you'll see that how to actually understand the question, whether is it the bad debt expense or is it the estimate for the year as a closing figure. Question?
Madam,
Yes.
The bad debt expense is the estimation or already?
The one here? This one becomes, okay. Why you have a bad debt here, it means that, right? In other words, you say that this is actually this transaction. The one that we are doing here is actually this one, estimate. You debit your bad debts and credit your ADD. Right? So, it's a funny way to explain this. I'm not sure how, right? But I also have difficulty to first understand. But when you look into the question, you know that, oh, whether this is a bad debt expense or this is the estimate, right? And again, this one is actually an estimate. But the entry for the estimate is debit your bad debt expense and credit your ADD. And how to get the bad debt expense is always the balancing figure. Right? How you get the balancing figure, then you have to look what will be your closing ADA. So that's why your closing ADA is a 3% of your account receivable. So you have the closing figure, then it becomes the balancing figure here. So this is your balancing figure. Okay? Right. I know that it's a bit confusing, but just stay put and do a lot more exercise, then you get through to that, right? You get the idea of why it is like that, right? If you don't get it now, just accept it first, yeah? Okay, and then the third requirement asks for the financial position, right? You do have prepared your trade receivable here. That's why you have a balance of 423,450, and your ADA closing is 12,704. So you have a net receivable of 410,74746. Okay. Let's go into the third question. I hope that we can finish this. We should be able to do this. All right. Can we go to question number 3? I know that I'm very fast now, but you can watch the video later, right? So if I'm fast, then you cannot fast forward my video because it's getting double fast. All right. So you have a balance of credit, say 1241. In addition, you have an adjusted balance of account receivable and allowance for doubtful debts. Objective evidence that 9% of 1,000 debt owed by debtor will become uncollectible, right? Most probably. So when you say that most probably become uncollectible, so it means that it's still an estimate. And agency of the rest of accounts estimated that 4% of the accounts will be non-collectible. Prepare the adjusting entry for MP country to recognize the bad debts. And then, all right, recognize the bad debt. So it means that, all right, so what do you understand from here? Once you compute 9% of the 50,000 and the balance 4%, right, that will be your closing ADA. Right, that will be the total estimate or the closing ADD for the year, and then the balancing figure would be your bad debts expense. Yeah, and show how account receivable allowance for doubtful debt appear on the company. Again, all right. So how you're going to do this? You have allowance of 5,200 credit. All right, and account receivable you have 475. But out of this 475,000, 50,000 is owed by debtor NB company, and you're going to provide estimate 9% to be bad, right? So how are you going to do that? Company MP, right? So what you have to do now is that, let me show you that, all right. You have, what was the company name? NB. NB company. What is the amount due? Never mind. It's 50,000. All right. What would be the estimated? It's 9%. So what would be the total? Is 50,000 times by 9%, 4,005. Balance account receivable will be, what is your total? Total receivable is 475. So plus 475,000 minus 50,000, right? You should get 425. So total account receivable is 475, but from that 475, 50,000 is Mr. MB company, and the balance is the other receivable, and you're going to provide 4% estimate. So what would be the estimate for the 4%? Would be 7,000. All right. So total would be 21,500. So 21,500 is the closing for your ADA. Remember that, right? So this is a closing for your ADA. So let's look into your ADA account. Opening balance, you have 5,200, right? ADA 5,200, so you credit 5,200, and then there is no other entries. It is that you have to, you know that you have a closing of 21,500. Where do you get this 21,500? Is from here, right? So once you have the closing 21,500, so this is your balancing figure. Okay, so your balancing figure here, 16,000 goes into your bad debt expense balancing figure, right? So what is your adjustment would be, your journal entry would be debit your bad debt expense 16,300 and credit your allowance 16,300. Right? Why you credit? See here on your ADA account, you credit the account. So that's why you credit ADA, but you debit your bad debt expense. Okay? So how is it going to appear in your accounts? Your account receivable. Your account receivable initially was 475. All right, and then you have allowance of 21,500. So your net trade receivable is 453,500. So I did that in 8 minutes. Okay. Is it 8 minutes? Not sure. 4 minutes maybe. Okay, clear? If you're not clear, all right, you have to digest and look again of my explanation, and hopefully help you to understand this topic. All right. Number 4, let's go into question number 4. Your journal entries, all right, and then prepare journal entries to record 1, 2, 3. Okay, so goods was 6,000 to Mr. Salam on credit. So what will be the journal entries? Come on, we only have 4 minutes. Switch on your audio. Debit.
Account receivable.
All right, credit.
Credit trade receivable.
Very good. Okay, next is that you accepted 6,000 6-month 8% note dated May from Mr. Salam in granting a time extension on his past due trade receivable. So what happened is that initially you have opened up account receivable on February 1st. But now May 1st, all right, you are going to cancel your account receivable because why? Now you issue note receivable 8%, 6 months. So May 1st, you're going to debit. What do you do? Right? So when you have cancellation of your account receivable, right? Where is it? Issue note receivable, cancel account receivable. So you debit your note receivable, credit your account receivable. So what you do is that your entry would be right? Debit your note receivable and credit your account receivable. So when you have these and these, right? Initially you debit, now you credit, so you cancel off your account receivable. Why? Because you cancel your account receivable because you open up your note receivable. You get that? All right. So then it says that on October 31st, Mr. Salam honors his note and make payment together with the interest. So when you receive payment from your notes receivable, what will be your journal entries? You receive cash, right? And then you're going to credit your note receivable, which was 6,000. And then you're going to credit also your interest income. In this case, there's no interest receivable because it's still within the same year, 31st of December, all right? So it's still the same year. So you don't have to accrue the interest, right? So now what you do is that you debit your cash, but your cash is, how you get your cash? The principal is 6,000. What will be your interest income? Right, that's how you compute. Right, your interest is plus 6,000 times by 8% times by how many months?
6 months.
6 over 12. 6 over 12. You get 2040, yeah. So that's how you get that 6240, right? So that 6240 is the principal plus your interest income. So you credit your note receivable and also you credit your interest revenue, right? So this one is your interest income or interest revenue on your note receivable. So that will be your adjusted, that will be your journal entries for your notes receivable when there's a owner of your note receivable. Okay, so we managed to settle question on tutorial 2. Can you do your tutorial 1 as well? Because next week, we are going to have your group exercise on accounts receivable. All right. You think that you understand the topic now better?
Yes.
Yeah. So hopefully this will help you to prepare for your group exercise. And remember, this topic will also be in your final exam. Yeah. So please do your tutorial number 1. I'm not sure. Our GE is on Tuesday or Thursday. Do you know?
Madam,
Yes.
is it GE or quiz?
Sorry?
Is it GE or quiz? Because in my schedule, it is written quiz.
I don't get it. Oh, is it GE or quiz? Is it?
Yes.
Oh, is it quiz or GE? I don't know. Oh, if it's a quiz, then it's individual, isn't it?
Yes.
Oh, quiz Alamak, banyak I kena marking. Then if it's a quiz, then it has to be a quiz lah. It has to be same for everybody, kan? Right, so it's a quiz, will be on Tuesday or Thursday. Do you know? Are the class Monday or Wednesday?
I don't know, madam.
Let's prepare is on Tuesday, right? So if you have anything else, any question, any other question? I will share with you this answer, right? So that you can refer to it. If
Madam,
yes.
can you show how to record statement of profit and loss?
Profit and loss.
Yes.
Profit and loss, you only have the bad debts here. Whatever you have bad debts. Mana question ada bad debts tadi? Bad debts. Alright, this amount bad debts will appear in your profit and loss account. Right, so you will have a bad debt expense of 15,654. Is that okay?
We just record for bad debt only,
Yeah,
or
record only for bad debt because your account receivable and your ADD is a financial position item.
oh, okay.
Yeah, bad debts only is in the profit and loss statement. Is it? So if you look at the summary, you only have one item, which is interest. All right, if you have interest income, that will also appear in your profit and loss account. Yeah. And then interest receivable is a financial position. It's your asset. Bad debt expense is in the profit and loss account. Okay?
Okay, madam.
All right. So if you have any question when you do your tutorial, another tutorial question, you can always WhatsApp in the group, all right, so that we can learn from the question, and then hopefully maybe someone else can help you to answer, if not me. Yeah. Okay?
Madam,
Yes.
for the quiz only cover in chapter 9, receivable. Is it multiple choice or?
No, it has to be something like this. Short essay. All right, because normally I think I have not looked into the question yet. This one quiz, yeah. It has to be multiple choice question and a short answer. Is it? I will update you later.
Okay, madam.
Right. Oh, I should stop recording. So if you don't have anything else, I thank you for your participation and your attention. I hope that you have learned something today. And please don't forget to forget what? Don't forget what?